This is The Memo by Howard Marks. On Bubble Watch. Exactly 25 years ago today, I published the first memo that brought a response from readers, after having written for almost 10 years without receiving any. The memo was called Bubble.com, and the subject was the irrational behavior I thought was taking place with respect to tech, internet, and e-commerce stocks. The memo had two things going for it. It was right, and it was right fast. One of the first great investment adages I learned in the early 1970s is that being too far ahead of your time is indistinguishable from being wrong. In this case, however, I wasn't too far ahead. This milestone anniversary gives me an occasion to write again about bubbles, a subject that's very much of interest today. Some of what I write here will be familiar to anyone who read my December memo about the macro picture. But that memo only went to Oaktree clients, so I'm going to recycle here the part of its content that relates to the subject of bubbles. Since I'm a credit investor, having stopped analyzing stocks nearly 5 decades ago, and since I've never ventured far into the world of technology, I'm certainly not going to say much about today's hot companies and their stocks. All of my observations will be generalities, but I'm hopeful they'll be relevant nonetheless. In this century's first decade, investors had the opportunity to participate in and lose money due to 2 spectacular bubbles. The first was the tech media telecom, TMT bubble of the late 90s, which began to burst in mid-2000. And the second was the housing bubble of the mid-aughts, which gave rise to A, extending mortgages to subprime borrowers who couldn't or wouldn't document income or assets, B, the structuring of those loans into levered, tranched mortgage-backed securities, and consequently, C, massive losses for investors in those securities, especially the financial institutions that had created them and retained some. As a result of those experiences, many people these days are on heightened alert for bubbles, and I'm often asked whether there's a bubble surrounding the Standard & Poor's 500 and the handful of stocks that have been leading it. The 7 top stocks in the S&P 500, the so-called Magnificent Seven, are Apple, Microsoft, Alphabet, Google's parent, Amazon.com, Nvidia, Meta, owner of Facebook, WhatsApp, and Instagram, and Tesla. I'm sure I don't have to go into detail regarding the performance of these stocks. Everyone's aware of the phenomenon. Suffice it to say that a small number of stocks have dominated the S&P 500 in recent years and have been responsible for a highly disproportionate share of its gains. A chart from Michael Sembalist, chief strategist at J.P. Morgan Asset Management, shows that the market capitalization of the 7 largest components of the S&P 500 represented 32 to 33% of the index's total capitalization at the end of October. That percentage is roughly double the leader's share 5 years ago, and prior to the emergence of the Magnificent Seven, the highest share for the top 7 stocks in the last 28 years was roughly 22% in 2000, at the height of the TMT bubble. It's also important to note that at the end of November, U.S. stocks represented over 70% of the MSCI World Index, the highest percentage since 1970, according to another Sembalist chart. Thus, it's clear that A, U.S. companies are worth a lot compared to the companies in other regions, and B, the top 7 U.S. stocks are worth a heightened amount relative to the rest of U.S. stocks. But is it a bubble? What is a bubble? Investment lingo comes and goes. My young Oaktree colleagues use a lot of terms these days for which I have to request translation. But bubble and crash have been in the financial lexicon for as long as I've been in the investment business, and I imagine they'll remain there for generations to come. Today, the mainstream media uses them broadly, and people seem to consider them to be subject to objective definition. But for me, a bubble or crash is more a state of mind than a quantitative calculation. In my view,
A bubble not only reflects a rapid rise in stock prices, but it is a temporary mania characterized by, or perhaps better, resulting from, the following. Highly irrational exuberance, to borrow a term from former Federal Reserve Chair Alan Greenspan.
Outright adoration of the subject companies or assets and a belief that they can't miss. Massive fear of being left behind if one fails to participate, FOMO, and resulting conviction that for these stocks, there's no price too high. No price too high stands out to me in particular. When you can't imagine any flaws in the argument and are terrified that your office mate, golf partner, brother-in-law, competitor will own the asset in question and you won't, it's hard to conclude there's a price at which you shouldn't buy. As Charles Kindleberger and Robert Aliber observed in the 5th edition of Manias, Panics, and Crashes, A History of Financial Crises, there is nothing so disturbing to one's well-being and judgment as to see a friend get rich. So, to discern a bubble, you can look at valuation parameters, but I've long believed a psychological diagnosis is more effective. Whenever I hear, there's no price too high, or one of its variants, a more disciplined investor might say, of course there's a price that's too high, but we're not there yet. I consider it a sure sign that a bubble is brewing. Roughly 50 years ago, an elder gave me the gift of one of my favorite maxims. I've written about it several times in my memos, but in my opinion, I can't do so often enough. It's the 3 stages of the bull market. The first stage usually comes on the heels of a market decline or crash that has left most investors licking their wounds and highly dispirited. At this point, only a few unusually insightful people are capable of imagining that there could be improvement ahead. In the second stage, the economy, companies, and markets are doing well, and most people accept that improvement is actually taking place.
In the third stage, after a period in which the economic news has been great, companies have reported soaring earnings, and stocks have appreciated wildly, everyone concludes that things can only get better forever.
The important inferences aren't with regard to economic or corporate events. They involve investor psychology. It's not a matter of what's happening in the macro world. It's how people view the developments. When few people think there can be improvement, security prices, by definition, don't incorporate much optimism. But when everyone believes things can only get better forever, it can be hard to find anything that's reasonably priced. Bubbles are marked by bubble thinking. Perhaps for working purposes, we should say that bubbles and crashes are times when extreme events cause people to lose their objectivity and view the world through highly skewed psychology, either too positive or too negative. Here's how Kindleberger put it in the 1st edition of Manias, Panics, and Crashes. As firms, or households, see others making profits from speculative purchases and resales, they tend to follow. When the number of firms and households indulging in these practices grows larger, bringing in segments of the population that are normally aloof from such ventures, speculation for profit leads away from normal, rational behavior to what have been described as manias, or bubbles. The word mania emphasizes the irrationality. Bubble foreshadows the bursting. For me, it's psychological extremeness that marks a bubble. Often, as Kindleberger indicates, it can be inferred from widespread participation in the investment fad of the moment, especially among non-financial types. Legend has it that J.P. Morgan knew there was a problem when the person shining his shoes started giving him stock tips. My partner John Frank says he saw it in 2000, when he heard the dads at his son's soccer game bragging about the tech stocks they owned, and again in 2006, when a Las Vegas cab driver told him about the 3 condos he'd purchased. When Mark Twain purportedly said, "History doesn't repeat itself, but it often rhymes," it's this kind of thing he was talking about. The new thing. If bubble thinking is irrational, what is it that permits investors to get away from rational thinking, like the thrust of a rocket ship that breaks free of the limits imposed by gravity and attains escape velocity? There's a simple answer: newness. This phenomenon relies on another time-honored investment phrase. This time is different. Bubbles are invariably associated with new developments. There were bubbles in the Nifty 50 stocks in the 1960s. More on them later. Disk drive companies in the 1980s, TMT/internet stocks in the late 1990s, and subprime mortgage-backed securities in 2004 to 06. These relatively recent manias followed in the tradition of ones like A, the 1630s craze in Holland over recently introduced tulips, and B, the South Sea bubble in 1720 England concerning the riches that were sure to ensue from a trading monopoly that the Crown had awarded to the South Sea Company.
In normal circumstances, if an industry's or a country's securities are attracting unusually high valuations,
investment historians are able to point out that, in the past, those stocks had never sold at more than an X% premium over the average, or some similar metric. In this way, attention to history can serve as a tether, keeping a favored group grounded on terra firma. But if something's new, meaning there is no history, then there's nothing to temper enthusiasm. After all, it's owned by the brightest people, the ones who are showing up in the headlines and on TV, and they've made a fortune. Who's willing to throw a wet blanket over that party or sit out that dance? The explanation often lies in Hans Christian Andersen's story, The Emperor's New Clothes. Con men sell the emperor an allegedly gorgeous suit of clothes that only intelligent people can see. But in actuality, there is no suit. When the emperor parades around town naked, the citizens are afraid to say they don't see a suit, since that would mark them as unintelligent. This goes on unchecked until a young boy steps out of the crowd and, in his naivete, points out that the emperor has no clothes. Most people would rather go along with a shared delusion that's making investors buckets of money than say something to the contrary and appear to be dummies. When a whole market or a group of securities is blasting off and a specious idea is making its adherents rich, few people will risk calling it out. My baptism under fire. They say experience is what you got when you didn't get what you wanted, and I got my most formative experience at the very beginning of my career. As many of my memo readers know, I joined the Equity Research Department at First National Citibank, now Citi, in September 1969. As was the case with most of the so-called money center banks, Citi invested mainly in the Nifty 50, stocks of the best and fastest-growing companies in America.
these companies were considered to be so good that A, nothing bad could ever happen, and B, there was no price too high for their stocks. Literally.
3 factors contributed to investors' fascination with these stocks. First, the U.S. economy grew strongly in the post-World War II period. Second, these companies benefited from their involvement with areas of innovation such as computers, drugs, and consumer products. And third, they represented the first wave of growth stocks, a new investment style that separately became a fad in itself. The Nifty 50 were the object of the first big bubble in roughly 40 years. And since there hadn't been one for so long, investors had forgotten what a bubble looks like. As a result of the popularity that was conferred on them, if you bought these stocks on the day I started work and held them tenaciously for 5 years, you lost well over 90% of your money in the best companies in America. What happened? The Nifty 50 had been put on a pedestal, and investors get hurt when something falls from it. The stock market as a whole declined by about half in 1973 to 74.
And it turned out these stocks had been selling at prices that actually were too high. In many cases, their price-to-earnings ratios fell from the range of 60 to 90 to the range of 6 to 9. That's the easy way to lose 90%.
Further, bad things actually did happen to several of the companies in fundamental terms. My early brush with a genuine bubble caused me to formulate some guiding principles that carried me through the next 50-odd years. It's not what you buy, it's what you pay that counts. Good investing doesn't come from buying good things, but from buying things well. There's no asset so good that it can't become overpriced and thus dangerous, and there are few assets so bad that they can't get cheap enough to be a bargain. Things can only get better.
The bubbles I've lived through have all involved innovations, as I noted previously, and many of those were either overestimated or not fully understood.
The attractions of a new product or way of doing business are usually obvious, but the potholes and pitfalls are often hidden and only discovered in trying times. A new company may completely outclass its predecessors, but investors who by definition lack experience in this new field often fail to grasp that even a bright newcomer can be supplanted. The disruptors can be disrupted, whether by skillful competitors or even newer technologies. In my early decades in business, technology seemed to evolve gradually.
Computers, drugs, and other innovative products improved a little at a time.
But in the 1990s, innovation came in a big rush. When Oaktree was founded in 1995, I insisted that I could get by with just WordPerfect for word processing and Lotus 123 for spreadsheets. But when we moved to our current office in 1998, I threw in the towel and let our IT team install email and the internet. And of course, WordPerfect gave way to Word and Lotus 123 to Excel. At the time, investors were sure the internet will change the world. It certainly looked that way, and that assumption prompted tremendous demand for everything internet-related. E-commerce stocks went public at seemingly high prices and then tripled the first day.
There was a real gold rush.
There's usually a grain of truth that underlies every mania and bubble. It just gets taken too far. It's clear that the internet absolutely did change the world. In fact, we can't imagine a world without it. But the vast majority of internet and e-commerce companies that soared in the late 90s bubble ended up worthless. When a bubble burst in my early investing days, the Wall Street Journal would run a box on the front page listing stocks that were down by 90%. In the aftermath of the TMT bubble, they'd lost 99%.
When something is on the pedestal of popularity, the risk of a decline is high.
When people assume, and price in, an expectation that things can only get better, the damage done by negative surprises is profound. When something is new, the competitors and disruptive technologies have yet to arrive. The merit may be there, but if it's overestimated, it can be overpriced, only to evaporate when reality sets in. In the real world, trees don't grow to the sky. The foregoing discussion centered on the risk of overestimating fundamental strength.
But optimism surrounding the power and potential of the new thing often causes the error to be compounded through the assignment of too high a stock price. As mentioned previously, for something new, there by definition is no historical indicator of what an appropriate valuation might be.
Further, the company's potential hasn't yet been turned into steady-state profits, meaning the thing that's being valued is conjectural. In the TMT bubble, the companies didn't have earnings, so PE ratios were out. And as startups, they often didn't have revenues to value. As a result, new metrics were invented, and trusting investors ended up paying a multiple of clicks or eyeballs, regardless of whether these measurables could be turned into revenues and profits.
Since bubble participants can't imagine there being any downside, they tend to award valuations that assume success.
In fact, it's not infrequent for investors to treat all contenders in a new field as likely to succeed, whereas in reality, only a few may thrive, or perhaps even survive. Ultimately, with a really hot new thing, investors can adopt what I call a lottery ticket mentality.
If a successful startup in a hot field can return 200x, it's mathematically worth investing in, even if it's only 1% likely to succeed.
And what doesn't have a 1% likelihood of success? When investors think this way, there are few limits on what they'll support or the prices they'll pay. Obviously, investors can get caught up in the race to buy the new thing. That's where the bubble comes in. What's the appropriate price to pay for a bright future? If there's a company for sale that will make $1 million next year and then shut down, how much would you pay for it? The right answer is a little less than $1 million, so that you'll have a positive return on your money.
But stocks are priced at PE multiples, that is, multiples of next year's earnings. Why? Because presumably they won't earn profits for just 1 year. They'll go on making money for many more.
When you buy a stock, you buy a share of the company's earnings every year into the future. The price of the S&P 500 has averaged roughly 16 times earnings in the post-World War II period.
This is typically described as meaning you're paying for 16 years of earnings.
It's actually more than that, though, because the process of discounting makes $1 of profit in the future worth less than $1 today. The current value of a company is the discounted present value of its future earnings. So, a PE ratio of 16 means you're paying for more than 20 years of earnings, depending on the interest rate at which future earnings are discounted. In bubbles, hot stocks sell for considerably more than 16 times earnings. Remember the 60 to 90 times for the Nifty 50.
Investors in 1969 were paying for companies' earnings, even after giving them credit for significant earnings growth many decades into the future.
Did they do so consciously and analytically? Not that I recall. Investors thought of a PE ratio as just a number, if they thought about it at all. Today's S&P leading companies are, in many ways, much better than the best companies of the past. They enjoy massive technological advantages.
They have vast scale, dominant market shares, and thus above-average profit margins.
And since their products are based on ideas more than metal, the marginal cost of producing an additional unit is low, meaning their marginal profitability is unusually high. The further good news is that today's leaders don't trade at the PE ratios investors applied to the Nifty 50. Perhaps the sexiest of the seven is NVIDIA, the leading designer of chips for artificial intelligence. Its current multiple of future earnings is in the low 30s, depending on which earnings estimate you believe. While double the average post-war PE on the S&P 500, that's cheap compared to the Nifty 50. But what does a multiple in the 30s imply? First, that investors think NVIDIA will be in business for decades to come. Second, that its profits will grow throughout those decades. And third, that it won't be supplanted by competitors. In other words, investors are assuming NVIDIA will demonstrate persistence. But persistence isn't easily achieved, especially in high-tech fields where new technologies can arise and new competitors can leapfrog incumbents. It's worth noting, for example, that only about half the Nifty 50, as enumerated by Wikipedia, there is no agreed-on list, are in the S&P 500 today. That figure undoubtedly looks worse than the reality, since mergers and acquisitions caused some of the old names to disappear, not failures. Leading lights of 1969 that are missing from the S&P 500 today include Xerox, Kodak, Polaroid, Avon, Burroughs, Digital Equipment, and my favorite, Simplicity Pattern. How many people make their own clothing these days? Another indication of how hard it is to persist can be seen in the names of the top 20 S&P 500 companies. At the beginning of 2000, according to finhacker.cz, these 20 companies were the most heavily represented in the index. Microsoft, General Electric, Cisco Systems, Walmart, ExxonMobil, Intel, Citigroup, IBM, Oracle, Home Depot, Merck, Coca-Cola, Procter & Gamble, AIG, Johnson & Johnson, Qualcomm, Bristol-Myers Squibb, Pfizer, AT&T, Verizon.
At the beginning of 2024, however,
only 6 of them were still in the top 20. Microsoft, Walmart, ExxonMobil, Johnson & Johnson, Procter & Gamble, Home Depot.
Importantly,
of today's Magnificent 7, only Microsoft was in the top 20 24 years ago. In bubbles, investors treat the leading companies, and pay for their stocks, as though the firms are sure to remain leaders for decades. Some do, and some don't. But change seems to be more the rule than persistence. Whole markets.
The greatest bubbles usually originate in connection with innovations, mostly technological or financial, and they initially affect a small group of stocks. But sometimes they extend to whole markets as the fervor for a bubble group spreads to everything.
In the 1990s, the S&P 500 was borne aloft by A, the continuing decline of interest rates from their inflation-fighting peak in the early 1980s, and B, the return of investor enthusiasm for stocks that had been lost in the traumatic 70s.
Technological innovation and the rapid earnings growth of the high-tech companies added to the excitement.
And an upswing in the popularity of stocks was reinforced by new academic research showing there had never been a long period in which the S&P 500 failed to outperform bonds, cash, and inflation. The combination of these positive factors caused the annual return on the index to average more than 20% for the decade. I've never seen another period like it. I always say the riskiest thing in the world is the belief that there's no risk. In a similar vein, heated buying spurred by the observation that stocks had never performed poorly for a long period caused stock prices to rise to a point from which they were destined to do just that. In my view, that's George Soros's investment reflexivity at work.
Stocks were tarred in the bursting of the TMT bubble, and the S&P 500 declined in 2000, 2001, and 2002 for the first 3-year decline since 1939 during the Great Depression. As a consequence of this poor performance, investors deserted stocks en masse, causing the S&P 500 to have a cumulative return of 0 for the more than 11 years from the bubble peak in mid-2000 until December 2011.
Lately, I've been repeating a quote I attribute to Warren Buffett. When investors forget that corporate profits grow about 7% per year, they tend to get into trouble. What this means is that if corporate profits grow at 7% a year and stocks, which represent a share in corporate profits, appreciate at 20% a year for a while, eventually stocks will be so highly priced relative to their earnings that they'll be risky. I recently asked Warren for a source on the quote, and he told me he never said it. But I think it's great, so I keep using it. The point is that when stocks rise too fast, out of proportion to the growth in the underlying company's earnings, they're unlikely to keep on appreciating. Michael Sembalist has another chart that makes this point. It shows that prior to 2 years ago, there were only 4 times in the history of the S&P 500 when it returned 20% or more for 2 years in a row.
In 3 of those 4 instances, a small sample, mind you, the index declined in the subsequent 2-year period. The exception was 1995 to 98, when the powerful TMT bubble caused the decline to be delayed until 2000.
But then the index lost almost 40% in 3 years.
In the last 2 years, it's happened for the 5th time.
The S&P 500 was up 26% in 2023 and 25% in 2024 for the best 2-year stretch since 1997 to 98. That brings us to 2025. What lies ahead?
The cautionary signs today include these: the optimism that has prevailed in the markets since late 2022, the above-average valuation on the S&P 500, and the fact that its stocks in most industrial groups sell at higher multiples than stocks in those industries in the rest of the world. The enthusiasm that is being applied to the new thing of AI, and perhaps the extension of that positive psychology to other high-tech areas. The implicit presumption that the top 7 companies will continue to be successful.
And the possibility that some of the appreciation of the S&P has stemmed from automated buying of these stocks by index investors without regard for their intrinsic value. Finally, while I'm at it, although it's not directly related to stocks, I have to mention Bitcoin.
Regardless of its merit, the fact that its price rose 465% in the last 2 years doesn't suggest an overabundance of caution.
I often find that just as I'm about to release a memo for publication, something comes along that demands inclusion.
And it has happened again.
On the last day of 2024, I received something from 2 sources that fits that description.
The graph from J.P. Morgan Asset Management has a square for each month from 1988 through late 2024, meaning there are just short of 324 monthly observations, 27 years times 12. Each square shows the forward PE ratio on the S&P 500 at the time and the annualized return over the subsequent 10 years. The graph gives rise to some important observations.
There's a strong relationship between starting valuations and subsequent annualized 10-year returns. Higher starting valuations consistently lead to lower returns, and vice versa.
There are minor variations in the observations, but no serious exceptions. Today's PE ratio is clearly well into the top decile of observations. In that 27-year period, when people bought the S&P at price-to-earnings ratios in line with today's multiple of 22, they always earned 10-year returns between plus 2% and minus 2%.
In November, a couple of leading banks came out with projected 10-year returns for the S&P 500 in the low to mid-single digits. The just-mentioned relationship is the reason. It shouldn't come as a surprise that the return on an investment is significantly a function of the price paid for it. For that reason, investors clearly shouldn't be indifferent to today's market valuation. You might say making plus or minus 2% wouldn't be the worst thing in the world.
And that's certainly true if stocks were to sit still for the next 10 years as the company's earnings rose, bringing the multiples back to earth. But another possibility is that the multiple correction is compressed into a year or two, implying a big decline in stock prices such as we saw in 1973 to 74 and 2000 to 02. The result in that case wouldn't be benign.
These are the things to worry about. Here are the counter-arguments. The PE ratio on the S&P 500 is high, but not insane.
The Magnificent Seven are incredible companies, so their high PE ratios could be warranted.
I don't hear people saying there's no price too high, and the markets, while high-priced and perhaps frothy, don't seem nutty to me.
As I said at the start of this memo,
I'm not an equity investor, and I'm certainly no expert on technology. Thus, I can't speak authoritatively about whether we're in a bubble. I just want to lay out the facts as I see them and suggest how you might think about them, just as I did 25 years ago. I hope you'll keep listening for the next 25. January 7th, 2025. Thank you for listening to The Memo by Howard Marks. To hear more episodes, be sure to subscribe wherever you listen to podcasts. This podcast expresses the views of the author as of the date indicated, and such views are subject to change without notice. Oaktree has no duty or obligation to update the information contained herein. Further, Oaktree makes no representation, and it should not be assumed that past investment performance is an indication of future results. Moreover, wherever there is a potential for profit, there is also the possibility of loss. This podcast is being made available for educational purposes only and should not be used for any other purpose. The information contained herein does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or related financial instruments in any jurisdiction. Certain information contained herein concerning economic trends and performances based on or derived from information provided by independent third-party sources. Oaktree Capital Management, LP, Oaktree, believes that the sources from which such information has been obtained are reliable. However, it cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. This podcast, including the information contained herein, may not be copied, reproduced, republished, or posted in whole or in part in any form without the prior written consent of Oaktree.
Audiation.
Hello and welcome to Behind the Memo with Howard Marks. I'm Harry Whitelaw, and I'm delighted to welcome Howard to explore a recent memo that has received great reader interest, perhaps because it addresses something that is both enduring and topical: on bubble watch. So Howard, when most of us conceptualize a market bubble, we probably picture a line on a chart displaying some kind of financial metric and rocketing upwards. But you argue that a bubble isn't best defined by numbers, but instead by investor psychology.
Well, I think that's right, Harry. The line rocketing upward on the chart does indicate a bubble, but it doesn't give a sense for a bubble. And I think that you have to have both. I think that a bubble is both a time when prices for one asset or one asset class or a whole market are elevated. But to really understand it and be able to work with it, I think you have to grasp the emotional or psychological aspects. And a bubble is really a temporary mania. It is the excessiveness of the psychology that creates the phenomenon and characterizes the phenomenon, and then, of course, creates its vulnerability.
You incorporate one aspect of investor psychology into this definition, which is FOMO. And again, a quote by Kindleberger in the memo that I think probably made a lot of us chuckle is, "There's nothing so disturbing to one's well-being as to see a friend get rich."
Right. I think that if a bubble is a period when investors become unhinged, I think more than anything else, it is the fact that some people have been watching others get fabulously rich that unhinges them. And the element that keeps markets safe and sane is risk aversion. People don't like to lose money. And in particular, money lost counts more heavily for most people than money gained. Most people are ho-hum about making $100, but really pained to lose $100. So that makes people biased toward risk aversion. Because they are risk averse, however, they perform a function, they police the market, and they keep it safe and sane, as I say. They keep deals from being done that shouldn't be done. They keep borrowers from having access to money they shouldn't have, etc. The term is used sometimes, vigilantism. And sometimes they forget to do that. Sometimes people become inadequately risk averse, overly risk tolerant. People take on risks that they aren't really fit to bear, and they set the stage for subsequent bad outcomes when times turn bad. The fear of loss should be prominent. Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. When they're not performing the police function and keeping the market safe and sane, we have to redouble our efforts to do so independently. Sometimes FOMO, the fear of missing out, takes over from the fear of losing money. You can't elevate both simultaneously. And when people get crazy because they've been on the outside watching other people get rich, as Kindleberger says, they lose their ability to be rational and to say it's overpriced. It might have been a good idea 2 years ago when Joe bought it, but now he's made 5 times his money. It's probably not a good idea anymore. Or anyway, at minimum, it's a much less good idea. So I wish I'd been in on it, but I have to accept that I missed it. Well, that's a very mature-sounding inner monologue. But that corrosive effect that Kindleberger cites as being injurious to your mental well-being, well, it's a very powerful force that moves people to create bubbles.
And sometimes that excitement is around something that's previously unknown, a new product, a new service, a new idea. You write how that can whip existing positive, broad sentiment into a real frenzy. Most things move in a historical range, but for something totally new, we have no map. nothing to chart the course of a new technology, for example.
And it follows then that it's very easy to get off course, isn't it, Harry? Bubbles are usually around something new, something that captures and fires the imagination. And as you say, there's no historical precedent to indicate when people are behaving irrationally about it. So we have, let's see, the tulip craze in Holland, 1630, I believe. The South Sea bubble in England, 1720. We had several in the meantime. But of course, the one I remember best is the Nifty 50 bubble of the 60s, in which growth stock investing was just invented in the early 60s. So you had a new activity. And of course, people made a lot of money at it. So everybody else says, well, I have to get in on that. The companies that were the subject of the Nifty 50, the best and fastest growing companies in America, companies that were so great that nothing bad could ever happen, these were idolized. And rather than being viewed individually as, oh, I love Xerox or I love Polaroid, they were assembled into a group, if you will. And the group was given special recognition. IBM, Xerox, Kodak, Polaroid, Merck, Lilly, Hewlett-Packard, Perkin-Elmer, Texas Instruments, AIG, Coca-Cola, Avon products. The list went on.
Even poor old Simplicity Pattern, Howard, which you often pick out.
My favorite. When stocks are highly valued, you pay a high multiple of their current profitability in the expectation that the profitability will continue and perhaps even grow. Thus, the high price is predicated on something I call persistence. And when you look at something called Simplicity Pattern, which everybody thought was a great idea at the time, there was an implicit assumption that Americans would continue to make their own clothes. And how did that work out? Did it really make sense to buy the earnings of that company decades into the future, which is what people were doing? Anyway, these companies were adored. Growth stock investing was adored. When I walked into this business in September of 1969, the official dictum at First National City Bank, where I worked, and several of the other money center banks that engaged in that activity, was that there was no price too high for such a great company. And that phrase, to me, is extremely important.
I was going to say, if there's one facet of bubble attitude you'd take most opprobrium with, it's probably the idea that there's no price too high.
Well, I think that's right, because what no price too high says is there's no reason that needs to be applied, no analysis needs to be performed. The value process of saying, what can it do? What does that make it worth? How does the current price compare with its worth? That whole process goes out the window. So to me, when I hear no price too high, either explicitly or implicitly, I take that as a major warning signal. In 1999, the internet was really flowering. And what people said is the internet will change the world. So for an internet company or an e-commerce company, there's no price too high. And those sentences don't follow one from the other. Yes, the internet will change the world, but maybe there is a price too high for web grocer or a company that has the idea of selling pet food virtually. Maybe you can say, how much can they sell? How much can they make on that? What does that stream of profit look like? And what's it worth? The merest fact that something's new and exciting should not cause people to surrender their reason. And when they do so, you get in trouble. So I came into this business in 1969. People said the Nifty 50 are great. There's no price too high. If you bought those stocks the day I got to work in September of 69 and you held them tenaciously for 5 years, you lost well over 90% of your money. Why? Because A, something had happened deleterious to many of them, and B, the price had been too high and it came down to earth. It's as simple as that. And ignoring that potential really gets you into trouble. It made me conclude from that experience that there is no asset which is so good that it can't become too high priced and thus dangerous. That's one of the few absolute rules in this business, in my opinion.
Touching on that persistence point, Howard, often investors may justify paying up for a leading company because they're currently number one. But you make the really important point. Investors are sometimes paying with the assumption the leader will remain the leader forever. And yet history indicates it's extraordinarily hard for incumbents to remain in pole position. Most of them don't.
Well, that's right. And just think about the odds you're facing when you're a leader. Number one, will your industry continue to be a leader? Number two, will your particular technology continue to be the one that produces success, or will it be supplanted by a new technology? Number three, will a competitor be able to do it better? Will the leading company become calcified, ossified, bureaucratic, stodgy, and stop being innovative? Will a hungrier, younger company be more successful at innovating? Will the newcomer disrupt the leader? Will patents expire? Change is the rule. Development is the rule. And things don't stay the way they are, including the fact that the leaders of a given industry don't always remain the leaders. It's very challenging. And yet, when you buy a company at a price-earnings ratio, you're buying a share in the company, which is actually a share in the profitability, for years into the future. And the higher the price-earnings ratio, the longer you're buying the earnings for, and the more reliant you are on the assumption that this company will continue to lead if it's a leader and will continue to exhibit rapid growth. And sometimes they do, and sometimes they don't. But if you looked at the Nifty 50, the greatest companies in America in 1969, certainly half of them are no longer even in the Fortune 500. That is, the best 50, 25 of them from 69 are not in the top 500 in 2025. Now, some of them got merged or acquired. It's not that they all faltered, but many did, and certainly simplicity among them.
So you do provide us this interesting qualifier that excitement around something new is often based on something very genuine, like the power of the internet in the dot-com bubble. It did change all our lives, but sometimes the excitement gets dragged beyond its immediate commercial applicability.
Well, it's very challenging for something as powerful as a bubble to be created out of nothing. So I think there's invariably a grain of truth. Although, look, at the present time, people are having great success with a meme coin, and a meme coin is nothing but an idea. And nowadays, in the virtual world, the non-physical world, people are paying a lot for virtual assets, which may not even have any physical aspects.
I guess AI is a good example, though, right? Because we know AI is powerful, but we don't necessarily know how to value it. We're guessing a little bit.
Well, exactly. AI is the new thing, and it is assumed that it will change the world. I'm not so stodgy as to sit here and say it won't. It probably will, and everybody I hang out with engages in these parlor tricks. I gave an interview with a Korean media group a couple of months ago. They sent it back to me where I was speaking Korean. So the power of AI is unquestionable. How will it be used? What can it do better than prior efforts? At what cost? Will there be enough power? I just don't know. But the point is, great potential, no historical basis for imposing limits on enthusiasm. That's a great precursor for the kind of enthusiasm that sometimes leads to bubbles. So that necessary condition is satisfied. The thrill of the new thing and the fear of missing out is an incredibly powerful combination. I've seen it at work many times, and it'll never stop, in my opinion.
Well, we should also talk about the bursting of the bubble. At Oaktree, we're known as bargain hunters, but it's important to remember that to access the inevitable dislocation, you need to have remained cautious during the prior period where market sentiment's been overly positive. And that can be quite difficult to maintain that discipline.
Absolutely. First of all, if you jump on the bandwagon the same as everybody else, you'll use all your money to buy at elevated prices. And then when the bubble pops, you won't have any money to scoop up the bargains. Number two, your psyche will be shot. Having participated in what then turns out to have been a mindless pursuit in the bubble, you won't have the resolve. You'll lose faith in yourself. And when you can buy the same asset for a fifth the price, you'll say, but how do I know it's cheap enough? Just as you couldn't recognize when it was too expensive, you won't be able to recognize and get motivated when it's too cheap. We pride ourselves on bargain purchases. We say we're in business to buy assets for less than they're worth. But that requires cooperation from somebody else who's willing to sell it to us for less than it's worth. Why would anybody do that? The reason they do it is because they bought it higher. They've seen deterioration of the economy and the company and the earnings and their own psyches. They've seen the price collapse. They've lost confidence. Whereas when you bought it at 90, you were sure it was going to go to 200. Now that it has fallen to 50, you're not so confident that it's not going to go to 10. So you say, get me out at any price. I can't take it anymore. It's the reverse of FOMO. It's fear of continued irrational losses. However, now, in order to have money left with which to buy up bargains when the bubble pops, you have to have had some in reserve. You have to have not been fully committed during the bubble. That's hard. Everybody else is making money. You don't want to miss out. It's hard to maintain high standards when everybody else around you is losing their standards and bidding for the new thing, even at prices that seem nutty. But you have to do that, or you can't be exceptional if you succumb to the influences that are dominating everyone. Dave Swenson, who ran the endowment at Yale with incredible success from 1985 to 2020 when he passed away, said in his book, Pioneering Portfolio Management, that investment management requires the assumption of uncomfortably idiosyncratic positions. And I find uncomfortably idiosyncratic the two most beautiful words I ever heard, because let's take the example in a bubble. You must not succumb. You must not be an average participant in the bubble, because the average participant gets eviscerated when the bubble collapses. Your behavior has to be idiosyncratic, which is to say you have to not participate, or certainly not participate to the same extent of everybody else. Idiosyncratic, but by definition uncomfortable. And if everybody else is doing something and making money at it, and you're not doing it because you believe it's overdone and it's an error, you're watching from the sidelines, they're getting rich. If you're not uncomfortable with that, there's probably something wrong with you. But to be a great investor or a great participant in any sphere of activity, you have to have the strength to avoid doing what others are doing when it is ill-founded.
So the memo mainly addresses equity market bubbles, but recently you've written that perhaps market participants underestimate just how different ownership and lending assets are in kind. So we should expect a credit bubble to look a little bit different to an equity bubble.
Well, that's right. I believe there are two main forms of investing, owning and lending. You want to start a business, Harry? I like you. I think you have a lot of potential. I want to be part of your success. So I can put up half the money for your company. Maybe I can own half of it, and I participate in your profits if there are profits, but I also share in the losses if there are losses. I'm not guaranteed anything. I just get my share of the outcome. The alternative is I'm not that comfortable with your likelihood of success. So I say, I don't really want to be an owner, but I'll lend you money. I'll give you the money you need to get into business. And you promise me you'll pay me interest every 6 months. And then at the end of some term, 7 years, 10 years, whatever it might be, you'll give me my money back. So I have a promise from you. I have a contract with you for interest and the repayment of principal. And that contract provides me with a contractual return. Those are the two forms of investing. So ownership means stocks, companies, buildings, commodities, and lending is loans, bonds, notes, debt, whatever you want to call that. And they're very different in kind. So you're right. We've been talking mainly about bubbles in ownership. Bubbles in the stock market is where we see them most of the time. The same excessive, undisciplined psychology occurs in the lending markets, but it takes a different form. And basically, the form it takes is what I call the race to the bottom, is that when people have too much money and they're too eager to put it to work and too eager to make loans, they compete to be the one who gets to make the loan. And that competition takes the form of saying, I'll do it for a lower rate of interest. I'll do it with less safety. I'll lend enough money to let you get levered up to the point where it might be dangerous. And I'll do it on the basis of weak documentation, the absence of what we call protective covenants, and I'll do it without security from collateral or assets. So it's a somewhat more subtle form of bubble behavior because it's really in the terms. But it's people saying, I want to do this business. I'll take more risk than my competitor and I'll settle for lower return than my competitor because I want the business.
I guess one thing that helps with the credit, though, is that nothing more than survival is really needed, whereas sustaining a high equity valuation means you do need to provide exceptional business performance continually. Credit you often write if you buy a bond at an 8% yield. All you need is the company to survive, and you get your 8%.
Right. So, if you will, the channel of outcomes is much narrower in lending. If you get survival, you get the return you expected. You don't fall short because they pay you 100% of what they promised. You also don't have a windfall gain because it's not going to double or triple. At best, it's going to give you the return you were promised. In equity, there's no promise. There's significant downside. There's lots of uncertainty as to what the outcome will be. But there's also the promise of a higher return, which induced you to take the ownership risk in the first place, and then the ever-present possibility of upside beyond that. A pleasant surprise from owning something that does better than expected or gets hot. So the shape of the probability distribution is incredibly different for ownership assets versus lending, and people should keep that in mind.
We should wrap up with talking, I think, about asset allocation. Your guidance is for investors to first identify their own risk posture and then adjust accordingly based on the environment, where they are in the cycle. How should we think about that today? Is a bit more defensiveness warranted?
Yeah, I think it's really important, Harry, what you just said. I think I wrote in my first book, The Most Important Thing, that people say to me, do you know any good investments? And that's like going to a doctor and saying, do you have any good medicines? The real question that you have to ask first is, what condition are you trying to treat? So the choice of investment media should be dependent on what the person is trying to accomplish. And if you say, my goal is to make the very most money I possibly could, well, then you need all ownership assets and probably very aggressive ownership assets. If you say, my goal is to make a reasonable return with a high degree of confidence and not much downside potential, then you probably don't want many ownership assets. You certainly don't want the aggressive ones. You probably want to engage in a lot of lending. So I think it's very, very important to put that question first. What condition are you trying to treat? So people should come up with the answer to that. They should, maybe with help, arrive at a portfolio composition that will permit them to accomplish it most of the time. They should probably have some combination of ownership assets and lending. And then the other part of the equation is the one you mentioned, Harry. Some people may want to change their asset mix from time to time as conditions change. Now, you can either do it well or poorly. So the person who has a mix of ownership assets and lending might, as the market does better, want to ramp up their percentage in ownership assets. But that is what we call trend following. And you can't gain participation in the profits that have already occurred by buying more of something, more ownership investments. And in fact, maybe you're just jumping on the bandwagon too late. Maybe you're just jumping on as it heads into bubble territory. So it's really important to not be a trend follower and to try to do this on the basis of values and analytically derived potential rather than emotion and trying to catch up with the people who've already made money. And it works in both directions, by the way. When things go poorly and people say, well, now I want to get out of risky assets, maybe it's too late. And at that point, maybe reducing their ownership assets will be tantamount to locking in losses and selling at prices that are too low to bargain hunters like us. So it's important to do these things analytically as opposed to under the dictates of emotion.
Thanks, Howard. I'm regretting that we can't display your probability curves in the podcast format, but I'll direct our listeners to Howard's asset allocation memo to see them. We hope you all enjoyed listening, and please do look out for future episodes on the Oaktree website or wherever you get your podcasts. And of course, all Howard's memos, all 35 years of them, can be found on the Insights section of the Oaktree website.
This podcast expresses the views of the author as of the date indicated, and such views are subject to change without notice. Oaktree has no duty or obligation to update the information contained herein. Further, Oaktree makes no representation, and it should not be assumed that past investment performance is an indication of future results. Moreover, wherever there is a potential for profit, there is also the possibility of loss. This podcast is being made available for educational purposes only and should not be used for any other purpose. The information contained herein does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or related financial instruments in any jurisdiction. Certain information contained herein concerning economic trends and performances based on or derived from information provided by independent third-party sources. Oaktree Capital Management, LP, Oaktree, believes that the sources from which such information has been obtained are reliable. However, it cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. This podcast, including the information contained herein, may not be copied, reproduced, republished, or posted in whole or in part in any form without the prior written consent of Oaktree.
Audiation.